I often receive comments and emails from folks asking me what happens to a covered call option on the expiration date. At the end of the market, on the expiration date, there are three primary questions surrounding the covered call option. First, what happens to the option contract? Second, what happens to the stocks that were held as collateral for the covered call option? And third, what happens to the premium payment? And the answers to these questions depends on where the market price closes relative to the strike price. So when the market price finishes below the strike price, here's what happened. For the actual contract, that contract is going to expire worthless. And this means that the option contract is no longer enforceable or can't be activated, and that's because the market price did not meet the terms and conditions of the contract, right? So the market price needed to finish above the strike price in order to be exercisable. And because the option contract expired worthless, that means that the shares that were reserved as collateral for the covered call, remember there's the underlying shares that were put up as collateral in order to fulfill the option contract in case it was exercised, well, those shares are released from the collateral and returned back to the seller, so the seller maintains ownership of those shares. And the last question involving the premium payment, well, that premium payment that was paid from the buyer to the seller in exchange for the rights of the option contract, well, that seller ends up keeping the premium that they received. Now let's take a look at what happens when the market price finishes above the strike price. So this is the opposite condition of the one I just described. Now when the market price finishes above the strike price, this contract is enforceable, and so the buyer actually exercises the contract. And what happens when the contract is exercised, it means that the underlying shares reserved as collateral will now be assigned to the buyer. And the buyer will actually pay for those shares, and the seller will receive payment for those same shares based upon the strike price. So if the strike price is $10, but the market price is $11, so it's above the strike price, the buyer will still only pay $10 per share as specified by the strike price of the option contract. And the last question about what happens to the premium payment as it applies to when the market price finishes above the strike price, well, it turns out the outcome is exactly the same. The seller still keeps the full premium payment that they received for selling the covered call option contract in the first place. And now you can get access to me by joining my Discord community, where you'll be invited to join my live trading sessions every week. Plus, you'll receive my trading notifications, and you'll have immediate access to my Ask Jim question and answer chat channel, where me and my team will respond directly to you about the questions you have about option trading. And don't forget my stock watch list, where I post all the best stocks that I'm watching for investing and trading opportunities. Plus, you'll receive immediate access to my Master Q&A videos, where we answer questions using demonstration and how-to videos that are both informational and educational. Plus, there's so much more. If you've got $1, you can get immediate access. So join today and get the first month for only $1. Sign up for immediate access by visiting my website, discord.simpleoptiontrading.com.